Hey guys, welcome back to the channel. In this video, we're going to update you on the stock market. We're going to talk about the job numbers that just came out. We're going to go over an article on what they said and basically why the market is edging lower before market open. Before we get into it, just remember, not a financial advisor. Make sure that you do your own research. If you find value in the video, smash the thumbs up button, subscribe to our channel if you enjoy our content, and hit the notification bell. That way YouTube will let you know every time we release new content. So payroll rose 390,000 in May, better than expected as companies keep hiring. So as we go through this, I'm going to read it and you're going to be like, okay, this sounds positive, and then eventually we'll get to the fact of why potentially the market is dipping pre-market. Then we'll look at the pre-market numbers and kind of go from there. Okay, and we'll maybe even check out the S&P 500 chart to check out the key support and resistance levels. So the U.S. economy added 390,000 jobs in May, better than expected despite fears of an economic slowdown and with roaring prices of inflation, the Bureau of Labor Statistics reported on Friday. At the same time, the unemployment rate held at 3.6%, just above the lowest level since December 1969. Economists surveyed by Dow Jones had been looking for a non-farm payrolls to expand by 328,000 and the unemployment rate to edge lower to 3.5%. May's total represented a pullback from the upwardly revised 436,000 in April and was the lowest monthly gain since April of 2021. Despite the slight cool down, the tight labor market is clearly sticking around and shrugging off fears of a downturn, said Daniel Zhao, Glassdoor senior economist. We continue to see signs of a healthy and competitive job market with no signs of stepping on the brakes yet. Average hourly earnings increased 0.3% from April, slightly lower than the 0.4 estimate. The year-over-year increase for wages of 5.2% was in line with the expectations. Stock market futures were volatile and pointed to a lower open on Wall Street following that report. Government bond yields moved higher. Job gains were broad-based. Leisure and hospitality led, adding 84,000 positions. Professional and business services rose by 75,000. Transportation and warehousing contributed 47,000, and construction jobs increased by 36,000. Other areas that saw notable gains included the government education, 36,000, private education, 33,000, healthcare, 28,000, manufacturing, 18,000, and wholesale trade, 14,000. Retail trade took a hit on the month, however, losing 61,000 in May, though the BLS noted that the sector remains 159,000 above its February 2020 pre-pandemic level. That's not really consistent with a consumer that's itching to spend on goods, Drew Mattis, chief marketing strategist at MetLife Investment Management, said of the retail numbers. The accommodation of food service story is telling you that people have shifted from goods spending to service spending. The real question is, how long will they sustain that? Despite the job gains, the BLS household survey showed that the labor market has yet to recover all of the positions lost during the pandemic. Total unemployment remains at 440,000 below the pre-COVID level. Labor force participation edged higher, raising 62.3%, though still 1.1% points below February 2020, as the labor force is smaller by 207,000 from that market. More encompassing measure of unemployment that takes into the account of those not looking for jobs and those holding part-time positions for economic reasons moved higher to 7.1%, up 0.1% percentage point from April. Unemployment for Asians fell 2.4%, while the rate for blacks was 6.2%, an increase of 0.3 percentage point. Revisions to the March and April job estimates shaved 22,000 off of the previous reported totals. Mattis said that the market reaction probably indicates that investors are both anticipating more Federal Reserve interest rate hikes and a slowing jobs market. Fed officials have said that they are looking to bring the jobs picture back into balance from the current high demand and low labor supply. I wouldn't call it the calm before the storm, but it might be the last bit of sunlight before the clouds get a little deeper and darker, Mattis said. The report comes amid fears that of higher inflation along with geopolitical developments, including the war in Ukraine and COVID restrictions in China, could impact the U.S. economy that contracted at a 1.5% rate in the first quarter. Though there have been recent signs that inflation could be slowing, the current pace is still around the fastest in 40 years. Prices at the pump specifically are at historic highs, with a gallon of gas unleaded at an average of $4.76 per gallon, up 13% from a month ago and more than 56% from a year ago, according to AAA. That is coming with a slowing economy that is currently on track to grow just at a 1.3% rate in the second quarter, according to the Federal Reserve. In an effort to control inflation, the Fed is trying to slow down the economy with a series of interest rate hikes. Fed Governor Lael Brainard told CNBC on Thursday she anticipates that further increases in the months ahead until inflation comes down to the central bank's 2% goal. Businesses have been hampered in the current environment, not least by a shortage of workers that has left nearly 2 job openings for every available worker. A Fed report earlier said this week that the businesses are expressing increasing concerns about future prospects. 8 of the central bank's 12 districts reported slowing growth, while 4 specifically cited recession fear. So not necessarily surprising on that on that front all the way around of, oh, we saw an increase in jobs, blah, blah, blah. Well, when you have so many jobs that went away over the past couple of years, it's kind of almost common sense that eventually they're going to start coming back. People are going to hire, and people are going to start new businesses, and people are going to do this and that, and you're going to see an increase in job numbers. But you got to think about why you have such a big increase in job numbers, because you had a bunch of jobs available originally to begin with. Talking about the retail spending, how we're transitioning from goods to services. I mean, the goods are so freaking high. Everything you want to buy right now is it's inflation. The numbers are inflated. The prices are inflated. It costs more to get it. Costs more to sell it. So people are probably scaling back now and don't want to spend as much as they do on normal type items. I know I am, and I know a lot of other people are as well. So let's take a look at the stock futures here. And this is as of 8:01 a.m. Central Standard Time, looking like we're going to be opening a red. And NASDAQ down 1%, a little over 1%, S&P almost 0.5%, and then the Dow 0.32% in the red, okay? And I'll be curious to see how low how low we go. So Fear and Greed Index, we're right at about 50-50 here, so could have gone either way, right? So it looks like we're going to go back down here. So let's going to take a look at the charts on here, guys, and let's see what they're telling us, and I'll kind of give you my feedback and opinion on what we can look for moving forward. All right, guys, taking a look at the charts for the S&P 500, and right here we're at a critical level. As you see, the first time that we came from the bottom here, we hit about 3,600, and we came up and we got above 3,800 and got rejected. And then here we go again. We poked our head right above 3,800, and there's a good chance today that we pull back down. I was actually finished at about 3,900 yesterday, but it looks like we're going to be pulling back down. So it's going to be interesting to see if we pull that far down back to back down to that 36 level. That's your overall level of support there for the 180-day 4-hour. Roughly right where we're at now is our resistance level. So we can go higher, great sign, especially going into next week. Today will obviously looking like we're going to have a red day, but if we can have a couple green days next week and kind of retest that 4,000 mark, that's going to be your next overall big level of resistance. But we got to have some type of positivity in the market before we get there. So looking like we could pull down again today, just not sure exactly how much. So are we at the bottom yet? That's the key thing is, originally I thought, okay, 3,800 is probably going to be the bottom, which was like here. And then as you see, we slid all the way back down to 36. So I said there, okay, we should be close to the bottom. And now we're poking our head at about 3,900. It looks like we're going to get pulled back down again. Now I'm kind of wondering, okay, are we going to stay and settle here at 3,600 if we do fall that low, or do we go lower? I'm not sure. So anyway, I just wanted to provide you that update, guys. Let me know your comments below. I'll be buying some of my stocks today since it's going to be red. I'm looking at Amazon. I'm looking at re-entering a AMC swing trade if it gets down low enough, and I'll be looking to potentially add to my ZNOG position for today. So let me know your comments below, guys. Other than that, enjoy your weekend. We'll catch you in the next one.